Stocks mostly higher, investors weighing the latest global trade developments, with U.S. tariffs on China taking effect, as U.S. tariffs on Mexico and Canada are put on pause for now. Joining me now, we've got Ben Gutteridge, who is the Invesco Portfolio Manager of Multi-Asset Strategies. So, Ben, how should investors be managing this policy uncertainty?
Well, nice to be with you. And look, this is clearly a pretty dramatic period for US trade policy, for global trade policy. And no surprises, I guess, that the longer it lingers, the longer it rumbles on, the more difficult I think it will be for stock markets to perform. But look, I still don't think this is the moment to get too defensive. I think we shouldn't forget what a strong hand the US has in these negotiations. And evidence of that is sort of seemingly from the relatively quick concessions we've seen from a couple of the negotiating partners, Mexico and Canada, very recently. But also that the US consumer is still in good shape. And that also on the political front, there are some more growth-infusing policies to come, deregulation, tax incentives. So look, on balance, I can well understand the nervousness that investors have, and absolutely steel yourselves for some continued volatility. But on balance, I think there's enough here to maintain a bias towards equities.
Ben, I wonder, in this kind of Venn diagram of Trump 1.0 and the tariff talks and the trade war during that time versus Trump 2.0, tariff talks now and tit for tat that's beginning to play out now, if there are any similarities that you're seeing start to formulate here, at least early days, and how investors should be thinking about that.
Well, I think, of course, that is a perfectly reasonable comparison to make. And in that period, we saw that tariffs are a difficult thing for economic growth to deal with, tends to weigh on growth. We saw risk appetite fall. We saw bond yields fall in that environment. But we did see that Trump is a deal maker, wants to get deals done. And I think we're seeing evidence of that play out again, which again promotes the impetus to take risk in portfolios. But one comparison that doesn't sit very neatly for me, and I know this sort of goes against my more sort of on balance, more positive view, is that period was a period of really absent inflation. At the moment, we're still sort of reeling from the lingering effects of a more troubling period for inflation. And I know it's keenly debated whether tariffs are inflationary or not, but in the short term, they certainly put a bit of pressure on upward pricing. And I think the Federal Reserve would be alert to that risk. So I think, trade war, persistent trade wars, yes, we would expect deals to be done, but it could be a difficult period as the Federal Reserve, further communicates that rate cuts are just sort of off the table while this drama plays out.
And so, this in mind, what strategies would investors be apt to consider to hedge tariff risks?
Well, I think hedging tariff risks is likely done through the bond market and having dollar assets, easier for a European investor like myself, but the bond market should perform well in a period of more troubled growth. But I think investors should be alert to the opportunity that presents should trade tariffs rumble on. I think, of course, the key incentive here is to deliver a better trading platform for US manufacturers. But in the short term, clearly frictions are going to be put in place to try and drive those deals. That's going to weigh on that part of the market, industrials and domestic manufacturers. But on the basis that we think deals can get done, that part of the market should enjoy quite a pop when those deals are struck. So as difficult as it may be, I think in the face of trade tariffs, I think nibbling away at industrials, financials is a good strategy. Domestic actors, but being prepared for volatility, but expecting some upside when things are resolved. But a more practical short-term hedge, I think, is the bond market.
Just lastly, while we have you here, let's talk a little UK equities, because you actually see this as a reasonable diversifier. Why is that?
Well, I think perhaps I would say that as a UK spokesperson. No matter.
I wasn't going to say that, Ben. I wasn't going to say that.
But look, I mean, cannot applaud enough the quality of businesses in the US stock market, the management, the innovation there. But clearly the sector biases do present some concentration risk. and potentially some valuation as risk. Wouldn't get too concerned, but they're certainly not outstanding. Don't appear outstandingly cheap. Whereas the UK stock market, diversification of sectors, certainly a greater commodity energy exposure, and some valuation and some dividend tailwinds as well. So I think a reasonable barbell at this moment. Although of course the outstanding growth companies still reside in the US.
Ben, thanks so much for the time. Really appreciate it.
My pleasure.